Let me ask you something brutal. You've watched hundreds of trading videos, you've read the books, you've studied the charts, you know the RSI, the MACD, the Fibonacci levels, you know all of it. So why are you still losing money? I'll tell you why, and it's going to sting. Because the problem is not your strategy, it's not the market, it's not your broker, your internet speed, or bad luck. The problem is how your brain is wired. 95% of traders fail, not because they don't know what to do. They fail because they can't control what's happening between their ears. But here's what nobody on YouTube is actually talking about. The traders who consistently make money, they don't just have different strategies, they have a completely different operating system inside their minds. And today, I'm going to crack that open for you. I'm talking about the exact psychological patterns, the mental frameworks, the deep cognitive rewiring that separates someone who makes $500 a month from someone who makes $50,000 a month, trading the same markets, the same stocks, the same setups. This is the video I wish someone had shown me before I blew up my first 3 trading accounts. Stay with me, because by the end of this video, the way you look at trading will never be the same again. Let's get into it. Before we get into the mindset of successful traders, I need to destroy a myth that the trading industry has been selling you for years. The myth goes like this: find the right strategy, follow the rules, and you'll make money. Sounds logical, right? Learn the setup, execute the trade, profit. But here's what actually happens. You find a strategy. It backtests beautifully. You paper trade it for 2 weeks and you're up 30%. You feel incredible. You feel like you've cracked the code. And then you go live and everything falls apart. You miss entries because you're scared. You hold losers too long because you just know it's going to come back. You cut winners too early because you want to lock in that profit before it disappears. You chase trades you missed. You revenge trade after a loss. Here's the uncomfortable truth that almost no trading educator will say out loud. The strategy is only 20% of the equation. The other 80% is psychology. I'm not making that number up. That's not just my opinion. Jack Schwager, the man who wrote Market Wizards, who interviewed the greatest traders on the planet, he came to the same conclusion. The traders who made it long-term weren't necessarily the smartest people in the room. They weren't the best technical analysts. They were the ones who had mastered themselves. And mastering yourself in trading means something very specific. It means you've learned to operate in a way that is fundamentally at odds with how the human brain is designed. Because here's the thing, evolution built your brain for survival in the savannah, not for the stock market. And every single instinct that kept your ancestors alive, in trading, those same instincts will destroy your account. Let me show you exactly what I mean. The human brain has 2 primary systems when it comes to decision making. System 1, fast, automatic, emotional, instinctive. This is your lizard brain. It reacts before you even consciously think. System 2, slow, deliberate, rational, analytical. This is your logical brain. It reasons through problems. Now, in normal life, System 1 keeps you safe. You see a car coming and you jump out of the way before you even decide to move. Beautiful system. Saved millions of lives. But in trading, System 1 is a wrecking ball. Because when you see your position going red, System 1 screams, "Danger, danger!" Close the trade. Even when your carefully designed strategy says, "Hold." This is normal drawdown. And here's what makes it worse. The financial markets are specifically designed, whether intentionally or not, to trigger your worst psychological tendencies at the worst possible moments. Think about it. The market drops sharply right before reversing, triggering your fear. The market pops to a new high right before pulling back, triggering your greed. Your stop gets hit by 1 tick, then the stock rallies 10% without you, triggering your frustration. It's like the market knows exactly which buttons to push, and it pushes them over and over and over again. So what do successful traders do differently? They don't just know about these psychological traps. They've built systems, internal systems, to neutralize them, to take their emotional brain out of the driver's seat and put their rational, process-driven brain in charge. Let me walk you through exactly how they do it. The number 1 mental shift that separates successful traders from struggling traders is this. Successful traders think in probabilities. Struggling traders think in predictions. Let me explain what that actually means in practice. When an average trader enters a trade, here's what's going on inside their head. This stock is going to go up. I can see it. The setup is perfect. The earnings were good. The news is positive. This is definitely going up. They predict. They form a conviction. They become emotionally invested in being right. And here's the problem with that. When you predict, being wrong becomes a personal failure. It becomes an ego threat. And when your ego is threatened, your brain stops making rational decisions and starts making defensive ones. You hold the loser to avoid proving yourself wrong. You add to the losing position to average down. You move your stop loss. You tell yourself the story that the market is wrong and you're right. Now contrast that with how a successful trader thinks about the same trade. A successful trader says, based on my historical data, this setup has played out in my favor approximately 60% of the time. My risk is $200. My potential reward is $600. This is a positive expected value trade. I'm going to take it, and whether it wins or loses this time is completely irrelevant to my long-term success. See the difference? It's not just words. It's a completely different operating framework. Let me give you an analogy that changed the way I think about this forever. Think about a casino. The casino doesn't predict which player is going to win or lose on any given spin of the roulette wheel. They don't know. And here's the thing, they don't care because they know their edge. They know that on every spin, the math is in their favor by a small but consistent percentage. They know that over thousands of spins, that mathematical edge will play out. A single player on a hot streak doesn't scare them. A big payout doesn't rattle them because they're not thinking about any individual spin. They're thinking about the aggregate result of all their spins. That is exactly how elite traders think about their trades. Each individual trade is just one spin of the roulette wheel. It might win, it might lose. The successful trader has no emotional attachment to the outcome of any single trade because they know their edge plays out over a large sample. This sounds simple, but developing this mindset deeply enough that it actually governs your behavior in a live trade, that takes months of deliberate work. Here's a practical exercise that top traders use to build this probability mindset. The R multiple framework. Every trade you take, define it in terms of R. 1 R equals your risk on the trade, the dollar amount you're willing to lose if you're wrong. If you risk $100 and make $300, that's a 3R winner. If you risk $100 and lose $100, that's a 1R loser. Now, write down your last 50 trades in R multiples. Don't look at dollar amounts. Just look at the distribution of R outcomes. What you'll find is a pattern. Your system has a certain expectancy. Maybe it wins 50% of the time at an average of 2R, meaning your expectancy is positive. Over time, that edge compounds. But more importantly, what this exercise does psychologically is it separates your identity from your individual trade outcomes. You stop saying, I won or I lost. You start saying, trade number 47 produced a 3R result consistent with my system's historical behavior. That is thinking in probabilities. And once you internalize that shift, losing trades stop feeling like failures. They start feeling like the necessary expected cost of operating a positive expectancy system. That is when everything changes. The second thing that separates elite traders from everyone else is their relationship with process versus outcome. Here's a question. 2 traders take the same trade. Same stock, same entry, same stop, same target. One wins, one loses. The coin lands differently for each of them. Which trader made the better decision? Most people, without thinking, say, well, the one who won, obviously. But that's completely wrong. And that error in thinking is one of the most expensive mistakes in all of trading. Because here's the reality. On any individual trade, whether you win or lose is substantially determined by randomness, by the specific tick-by-tick flow of that particular moment in the market, by factors entirely outside your control. What you can control, the only thing you can control, is the quality of your decision-making process. A good trader who makes a great decision can still lose that trade. A bad trader who makes a terrible decision can still win. In the short run, outcomes are noisy. In the long run, only process matters. Process, strategy, and Structure controllable. Outcome structure uncontrollable. Elite traders have internalized this so deeply that they literally measure their performance not by whether they made money in a given week, but by whether they followed their process. I know traders, real, consistently profitable traders, who have a bad month financially, but consider it a successful month because they executed their process flawlessly. And conversely, they've had months where they made money but felt like failures because they broke their rules to do it. That sounds strange from the outside, but it's one of the most sophisticated psychological frameworks in all of performance psychology, not just trading. Think about elite athletes for a moment. A championship basketball player doesn't evaluate a season by their scoring average. They evaluate it by whether they executed their form correctly on every shot, whether they followed the defensive schemes, whether they did the preparation work, because they know that if the process is consistently excellent, the outcomes take care of themselves over time. The same is true in trading. So what does a process obsession actually look like in practice? Let me walk you through what a successful trader's pre-trade routine looks like. Step 1. Market context analysis. Before they even look at individual trades, they ask, what is the macro context today? Is the broader market in a trending environment or a choppy environment? What are the key economic events today that could create volatility? Am I operating in a period where my strategy historically performs well? If the macro context doesn't support their strategy, they don't trade. Full stop. Many elite traders sit on their hands 60 to 70% of the days they're in front of the screen. They trade less than you think. They wait for exactly the right conditions. Step 2. Trade criteria checklist. Before entering any position, they run through a specific checklist, not in their head, on paper, or on a screen, every single time. That checklist might include, is the setup matching my specific pattern criteria? Is volume confirming the move? What is my exact stop loss level, and is it technically justified? What is my target, and is the risk reward at least 2.1? Am I in the right psychological state to trade right now? That last one is critical. We'll come back to it. Step 3. Execution without hesitation. Once the checklist is complete and all criteria are met, they pull the trigger immediately. No second guessing. No, maybe I'll wait for a little more confirmation. The setup either meets criteria or it doesn't. If it does, they act. Hesitation in trading is almost always a symptom of psychological interference, fear, self-doubt, past trauma from losses. Successful traders work very hard to eliminate hesitation through rigorous preparation and rule clarity. Step 4. Trade management protocol. They have predefined rules for how they manage the trade once they're in it, where they move the stop to break even, when they take partial profits, when they let it run. These decisions are made before the trade is on. Why? Because once you're in a trade and you have real money at risk, your judgment becomes compromised by your emotional state. You feel the pull of greed when it's going your way. You feel the fear when it pulls back. Your thinking is no longer objective. The solution is to remove as many in-trade decisions as possible by pre-deciding them in a calm, rational state before you enter. Step 5. Post-trade review. After every trade, win or lose, they write a brief review. Not just won 3R or lost 1R. They note, did I follow my process? Did I hesitate? Did I move my stop? Did I size correctly? What was my emotional state during the trade? Over time, this journal becomes one of the most valuable assets a trader can have. It shows you patterns in your own behavior that you can systematically eliminate or enhance. This is process obsession, and it is unsexy, unglamorous, deeply repetitive work. That's exactly why 95% of traders never do it, and exactly why the ones who do rise above the rest. I want to talk about something that most trading content refuses to touch directly, because it's uncomfortable, and that's the emotional reality of losing money. Losing money is painful, full stop. It activates the same neural pathways as physical pain. Brain imaging studies have shown that financial loss literally lights up the same areas of the brain as getting punched. And here's the brutal math of trading. If you're a trader with a 60% win rate, which is excellent by the way, you are still losing on 4 out of every 10 trades. You're losing almost half the time. And losing streaks, they're absolutely normal. 3, 4, 5, even 10 consecutive losing trades are completely within the statistical bounds of any legitimate trading system. But here's what happens to most traders when they hit a losing streak. They start doubting the strategy. They start adjusting entries midstream. They start skipping trades because they feel like this one will also lose. They start taking trades outside their criteria, trying to make back losses. They shrink their size out of fear and then miss the trade that would have recovered everything. The losing streak, which was a normal statistical event, becomes a catastrophe because the trader's psychological response to the losses destroyed their ability to execute their edge. Successful traders have a fundamentally different relationship with losses. Let me break down exactly what that looks like. Loss philosophy of elite traders. First, they expect losses. This isn't pessimism. It's mathematical sophistication. They know their system's historical win rate. They know the longest historical losing streak their system has produced. They've mentally prepared for it and have accepted it as an inevitable part of trading. When the loss comes, it's not a surprise. It's expected. It's part of the plan. Second, they define risk. Before entry, never after. The moment a successful trader enters a position, they know their maximum risk. Their stop loss is already set. They've already paid for that potential loss in their mind before the trade even begins. This is a subtle but powerful psychological shift. By mentally accepting the risk before the trade, the loss of capital when the stop hits doesn't feel like a new shock. It feels like confirming a cost that was already accounted for. Think of it like an insurance premium. When you pay car insurance every month, you don't feel like you're losing money. You've already accepted that cost as the price of driving. Elite traders think about every stop loss they pay as the premium for participation in the market. Third, they don't confuse the quality of a decision with its outcome. We talked about this earlier, but it bears repeating in the context of loss specifically. After a losing trade, the first question a successful trader asks is not, "Why did I lose?" The first question is, "Did I follow my rules?" If the answer is yes, the setup was valid, the risk was appropriate, the trade met all criteria, then the loss is not a failure. It's just a data point. The system worked. The market happened to go the other way this time. That's normal. If the answer is no, they traded an inferior setup, size too large, moved their stop. Then the loss is a failure, and they write it in their journal and work to correct the behavior. Not because of the money they lost, but because of the process they violated. This distinction is enormous. It means their emotional response to losing money is far less intense because the money outcome is not the primary metric of success. Fourth, they take breaks. This is one that even experienced traders forget. When you hit a losing streak, your brain enters a stress response that biochemically impairs your decision-making. Cortisol spikes. Your threat detection system becomes hypersensitive. Your ability to think long-term deteriorates. Elite traders recognize the signs: frustration, urgency, a feeling that they need to make back money, and they step away. Not forever, an hour, a day, sometimes a week. They know that no trade taken from a state of emotional reactivity will be their best work. And they know that the market will always be there. The opportunity doesn't disappear because they took a break. The average trader pushes through. They sit in front of the screen for 6 more hours trying to fight their way out of a hole. And they almost always dig it deeper. I want to share something personal here. The biggest single lesson I've learned in years of trading is this: your trading account is a direct reflection of your psychological state over time. When I'm disciplined, patient, process-focused, and emotionally regulated, my account grows steadily. When I'm reactive, impatient, chasing, fearful, greedy, or trying to prove something, my account reflects that too. The market is a mirror. It reflects you back to yourself with relentless precision. You cannot hide from it. And that's actually the beautiful, terrifying truth at the core of trading. It is, more than almost any other professional endeavor, a pure test of your ability to master yourself. Let me ask you a question. If I told you that you were going to flip a fair coin 1,000 times, and every time it lands heads, I give you $200, and every time it lands tails, you give me $100, Would you play? Absolutely. That's an incredible edge. Over 1,000 flips, you'd expect to make roughly $50,000. But here's the thing, you don't get to play all 1,000 flips at once. You have to play one flip a day, and some months, the coin is going to land tails 15 times in a row. Would you still play? Most people say yes intellectually, but in practice, most people would quit around flip number 20 after a rough week. They'd say, the coin is broken, this isn't working, I should stop. This is exactly what happens to traders. They have a legitimate edge, a strategy that genuinely works over hundreds of trades, but they abandon it during the normal statistical drawdown periods because they're thinking about this week's result instead of the result over 1,000 trades. Successful traders live in a completely different time horizon. When a successful trader takes a trade, they're not thinking, I need this trade to win. They're thinking, this is trade 247 in my ongoing execution of a positive expectancy system. This one trade is completely irrelevant to my long-term performance. My job today is simply to execute correctly. This long-term thinking protects them from two of the most destructive behaviors in trading: